Listen, Marco, actually, I want to use your framework for you to cash some, to pour some salt on one of my trades that I like recently, and that is buying India. And you have a chapter in the book where you walk up through the constraints. And to be fair, when I wrote this one up, I said, I know that every kind of few years, the hedge funds get all excited about India and it's the new discovered market, and then they eventually disappoint. And in your book, you walk through why that disappointment occurs and what people should be on the lookout for. Could you update us on, do you still feel the same about India, and am I making a mistake?
So you know what? I'm going to let the listener buy the book and read the chapter.
Okay.
Okay. But here, I'm going to add something that's not in the book.
Okay.
So since COVID, we've had this extraordinary amount of fiscal policy. We have some really interesting macro trends, such as what I call the race to zero, which is the sustainability, green tech, massive amount of spending on electrification, on EVs. We have policies that make me a dollar bear on the cyclical horizon. So what I'm getting at is that I'm firmly in the reflation camp. Now I'm playing this interregnum. I kind of saw it coming 2 months ago. Like, I'm comfortable with it. I don't have a problem. I just think it's an interregnum. It's like a mini intra-cyclical blip in the big cyclical theme, which is reflation. So the reason I would want to be bearish India is that India is the anti-reflation trade. And what I mean by that is that India will do well if commodities don't rally. India will do well if its imports are cheap. And that means energy, but it also means food. And my problem right now with India is that if I have the macro outlook for the next 5 years that I have, which is a dollar bear commodity bull, emerging market bull, but emerging markets that produce commodities, that export commodities, I'm not really an India bull in this case, almost no matter what Indian policymakers do. So that's the first issue. The macro context scares me. The second would be that I'm not sure that Indian policymakers are doing the structural reforms that they need to do. I think a lot of the reforms passed has been window dressing, and I think the Modi administration has kind of taken a wrong turn in a few directions over the past several years. For example, before COVID outbreak, there were protests in India against the national law that was passed. There's a lot of tensions rising in India even before the COVID recession. And then the third leg of my bearishness towards India would simply be that, after a deep recession, you usually see this bounce back in commodity prices that could be cyclical, as I think it is. I think it's going to be persistent. It could be temporary, as many who obviously don't believe in the reflation trade are betting. But there almost always is a commodity price increase. Even after the great financial crisis, we saw this, especially in food prices. And I worry that that's going to trickle to Indian politics over the next 6 to 12 months.
Okay.
So one of my biggest political risks right now is not like a China-US clash, although obviously that's scary too. I think one of the biggest concerns I have is a repeat of the Arab Spring scenario in countries that have to be very sensitive to higher food prices. And of course, India is part of that.
That's fascinating. Speaking of China, could you give me any insights about what you think, is happening there? We just had the Xi government making the education stocks an arm of the government and turned it into the not-for-profit sector. We've had them clamping down on all sorts of technological issues. What do you think's happening there, and do you have any insights that you could offer?
Yeah, absolutely. Actually, one of the reasons that I'm very happy to be a Clock Tower Group is that we have great coverage of China. We've been in China for many years. We have an office there. We work very closely with hedge fund managers in China. And as hedge fund managers anywhere else, they're not political, right? They're just trying to get the markets right. And so I love reading their insights and being able to tap that network. And for several months now, we've been hearing that income inequality is becoming a critical issue in China. And there's two reasons for this, Kevin, and they're very important for macro investors. One, China learned a completely different lesson from the great financial crisis relative to their American policymaker peers. American policymakers learned that they didn't stimulate enough. Chinese policymakers learned that they stimulated too much. And so since the COVID recession, China has done very little to support households, unlike the United States. You have this incredible alligator jaw chart when you look at household income growth in China and the US. US had this extraordinary situation where after a recession, household incomes grew. It's fascinating. Probably never happened in human history. And in China, they had, a household deleveraging. They are having a balance sheet recession in China. So households are hurting in China because of the decision by policymakers to not stimulate the way Americans did and to learn different lessons. The second thing that's happening in China, also kind of on a secular thesis, is that income inequality has basically risen due to development. And Chinese policymakers are starting to really worry about that. They're starting to worry about that because next year, you could argue, is their election year. Xi Jinping is supposed to extend his presidency for another 5-year term, which is breaking a norm, not necessarily a rule, but it's a norm. And the last thing that I think policymakers in China want is a middle class that feels that the quid pro quo between Chinese Communist Party and the middle classes in China is going to be broken. And that quid pro quo is that the Chinese Communist Party asks its middle class to accept the rule as long as they continue to deliver this middle class lifestyle, the China dream. And so I think that you should interpret almost every single policy decision in Beijing, whether it's on tutors, whether it's on internet stocks, in that prism. And the way we see it, the way we think about China is that China is abandoning the service sector model that they so enthusiastically wanted to follow, thanks to the American example. And what Chinese policymakers are saying is that the service sector model of the United States of America will lead to even greater income inequality issues. These internet giants, these internet companies are not good for, the growth of the middle class. It didn't help America. Why would it help us? So instead, they're pivoting to hard tech, and they call this hard tech versus soft tech. They're abandoning the soft tech approach, the service sector approach, and they're adopting a much more, Japanese German approach of hard tech, of keeping their manufacturing employment at a relatively high level. And that is a really important pivot. It's something that Peter Thiel called before atoms versus bits. It's something that I've been sensing is happening in our economy globally, not just China, US as well, where we're coming to the end of software dominance, of tech dominance, for a number of different reasons. But in China, one of those reasons is that policymakers themselves are accelerating that pivot back towards atoms, back towards industrials, materials, energy, and away from tech and IT. And I think that fundamentally, they believe that it will help resolve income inequality better. But also, I think there's a geopolitical reasoning too, where Chinese policymakers just don't think that, a mobility app is going to matter in an eventual confrontation with the United States. What's going to matter are batteries, airplanes, like trains, airplanes, and automobiles, right? Like real stuff. That's going to matter. And whether you have a mobility app or a really cool payment system, like cool story, bro, but that's not going to put a missile into an aircraft carrier.